So we're just proceeding from where we left off yesterday. So in the last session we had yesterday, I think we all were here. Those that were here, you actually understood what actually literally happened here. So the most important thing is you understanding your current order flow. Where are we? Which current order flow are we currently flowing in? Both on a higher time frame perspective. Then when it comes to entries, you just enter your lower time frame. Then you align trades alongside that order flow. So here we are still in bullish order flow. This was all bullish order flow. The major point that I was stating in yesterday's session that we had was the fact that the markets have never changed. The markets have never changed. The principles in which the markets have been moving, they have never changed. What is changing now is people are beginning to wake up now. It's not like there's any change that has happened to the market itself. The market has been the same. It will always be the same. It will remain the same. What is now beginning to happen is people now, they are beginning to wake up and starting to see the markets with a whole new perspective, with new eyes and new perspective. So they now think that the markets have changed. The markets have never changed. It's basically the people's perspective that has changed. So here, the most important thing that you must understand and get, once you get this, even the trade opportunities for this week, you even be able to analyze on your own if ever you understand what I'm illustrating now. So this is the higher time frame order flow. Order flow overall is bullish on a higher time frame, right? So what I now need to do now, since this entries and the first major TP, that major TP has been reached, the most important thing now for us to do and to take note of, we go back to the 4 hour. The most important thing for us to take note of now is, let me just mark my structure there on the 4 hour. So on the 4 hour, our previous internal leg was this one, where we had this internal break of structure like this, right? This was our previous internal. Even here, this was the opportunity that you're supposed to, the last major push up until they hit that TP was actually that one. Let me just remove all these so that let me just remove this. So this was the last push. This was the last push that broke both the internal structure TP as well as the overall external structure TP like that. So what you always see each and every single time whenever the market has finished its major higher time frame move like this, from this swing leg down to that swing leg up, one thing that you always experience next is you experience the creation of a new swing leg. How is a new swing leg created? By the shifting of this internal order flow. So this bullish order flow that you're seeing going up, down, up, down, up, down like this, up, down like this, is still a bullish internal order flow, right? So for them to create a new swing leg up there, wherever they are going to create it, they have to first break that order flow, shift that order flow from being bullish to bearish. So that's basically the most important thing that you must actually be looking out for. Here, this was a simple trade setup that, remember, when they tap a level like that, it's not even the level that is important, but the market, the response of the market to the level. So yeah, if you got the 15-minute or 30-minute, you actually would have seen the shift that happened there. Then you would have entered so easily. Then as they were now pushing to the upside like this, new high there, new low, new high. Even here, when they came back to retest here, you would have even bought here, stop loss below this level. New high there, even here, you would have bought stop loss below here. So up until they hit this TP like that. So after they do this, obviously, the first thing to always expect is the internal inducement first, for them to take out the internal inducement first before either they continue buying or they shift the overall structure right there. So those things are things that you must always wait for, especially if ever you did manage to take the trade like there. The waiting there is not even an issue to you, that inducement that happened there, right? So here we can literally see that they induced, this is an inducement. And then this one is a change of character like this, of which I told you that once they change this character, it means we now have a new swing leg. What is our new swing leg? We now have this as a swing, a higher high. It's high because it's higher than the previous swing, which was this one. So we now have a swing higher high. We now have a swing higher high, and our swing higher low is going to be the low that is going to take out our swing higher low is going to be the low that is going to take out this swing higher high like that. So here you realize that even coming down here, would have scalped sales, yes, but that was not really the main trade to look out for there. The main trade to look out for, you actually realize that right here. Let me just pause this. Okay, so here they've broken here already, and they've created their swing higher low right here, so close to the swing higher high, which is something that they also do. I've seen people whom after the market creates a new swing leg down here, obviously many people, they actually want the market to come all the way down here before it goes even halfway. Sometimes people, they actually anticipate, in as much as the markets can do that, but your mind must be open enough to understand that if ever price action shifts before they even get to the levels that you're anticipating, you just must respond to that shift in price action. So here, this is now our swing leg, and they are still bullish, as you can see. So it means now these inside legs that are going to be created as we'll be going forward are going to be legs that will be formed by inducement, right? Up until we shift the internal bullish order flow, we will not be having any swing higher high as yet. So our swing higher high is going to be at a point when that internal bullish order flow shifts to become bearish. So throughout the entire time, you are just following the internal legs that will be formed by your inducement legs. So yeah, they try to induce here. They failed up until they succeed. So doing that, this is now an internal structure higher high, right? Then once they do that, obviously you can do your normal thing, which you're used to, whereby you mark, you have, for example, you have this level. You also have a tapped demand, actually. This one was tapped here. So these are the two major extreme levels that I'm seeing where this market can come to before it buys, right? It can come there. Even if it doesn't come there, once you master the art of looking at the shift, identifying the price action, where it shifts. If it shifts, let's say here, if ever they shift here and actually take this out, overall, I'll be looking forward to for my next entries around those zones up there, not all the way down there. So even here, coming to the downside, there's a way to enter these counter trades to the downside, right? One of the ways is knowing this current, identifying this current bearish pullback. Because remember, as they'll be pulling back in form of a different price action to the current one where they are pushing towards. So yeah, you can even put a Fibonacci retracement tool like this. You can even use the Fibonacci retracement tool for TPs of taking counter trades. When if let's say you took counter sells from, let's say, this supply area, because here they are bearish coming to the downside. They broke here. They did this mini break here, like this. So you would have taken sales from there. TP, you would have targeted this, but overall, you would have even targeted this first. This could have been your first TP, second, third, fourth, fifth, blah, blah, up until we go all the way to the downside like that. So you can use Fibonacci, what do you call this? Fibonacci legs for your, you can use Fibonacci legs for your TPs whenever you're taking counter trades. You can actually utilize Fibonacci legs for that. So now, looking at structure from the daily point of view, if you look at structure from the daily point of view, you literally see that here, overall on the daily, it seems like they are still pushing to the upside, still pushing up, down, down, even this up, down. So they are literally still pushing upwardly according to the daily there. But now the good part is that now here we now have a swing higher low according to what we saw on the 4-hour, right? Because remember, if you understand the dynamics of of time frames, the difference of time frames, you understand that a daily inducement is basically your lower time frame change of character. That's basically what we call the confluence of time frames. If you understand the confluence of time frames, you literally see that a change of character, whether on a 4 hour, 1 hour, going to lower time frames down there. When you go to a higher time frame like the daily, weekly, or monthly, you will basically see it. It will basically appear as a simple inducement. So let me just play this. Right. So the most important thing now that we are seeing on the daily, like here on the daily. So remember, we now have this as a swing higher low. That was our swing higher low. And I said your swing higher high is going to be the level where this internal order flow on a lower time frame is going to change character up there. So here you literally see that there were buying opportunities that you could have actually taken advantage of on a lower time frame. Then here on a daily, this is appearing as an inducement on a daily. But if you go lower right now, you literally see that it's actually a change of character when you go to a lower time frame. So it means literally that this is now your swing higher high. And here they came back to the swing higher low. And let me go to the 4 hour, back to the 4 hour. Okay. So remember these zones that I drew previously, that I told you, this market can come there and it can also not come there. Your ability to identify the shift here, where did the shift happen? The shift, it literally happened right here. That's where the market shifted from coming down to going up. So identifying that shift as quickly as possible, it will help you to understand that they are not even coming all the way down there. So right there, when they did this shift, that's when you were actually supposed to be focusing on buys. People, they can come and draw all sorts of trend lines, like all these things and all whatever. Trend lines, if ever they don't, a trend line, if ever it doesn't break structure, is good as useless. So trend lines, you can put them, but if you don't understand structure as raw as it is, if you don't understand where the correct structure is, for example, here, let's say after having drawn a trend line like this and they fail to come and take this out, they could have still even, let's say here they broke here, but they failed to break this level. They could have simply broken the trend line, but literally kept on going down. So here, after doing that, obviously, they actually indeed broke our structure. So indeed, that was a simple buy to the upside. You would have used this as your first short-term target. Your second target is always the one where you align, where you follow through market structure up until where it shifts. So up until where we are going to induce, I can hold this buy that you take. So this buy, even if where were you supposed to take, according, if ever you're entering just using the 4 hour time from here, upon the break there, you could have entered, your stop loss could have just been here, just here on this leg here, because according to that, once the market shifts like this, they can't reshift again here before they finish the move. So here, that was where you would have put your stop loss there. Then as they went like that, so immediately after breaking this, you can actually lock profits here or shift stop loss to break even like that. Then as they go new high, new low, you are locking profits on these sub-internal higher lows there, new high, new low, new high. Right now you would have, so if you are following this idea of trailing market structure, following market structure up until the way it shifts, you would have literally closed your trade around this area there, which was a very, very, very clean setup and all that. So remember, they are still bullish. And now that's an inducement. That's not a change of character. People, they don't literally understand the difference between a change of character and an inducement. This one is an inducement, which is totally different from a change of character. The minute you say it's a change of character, by the time the market comes back to the extreme supply up there, if ever there's any supply order block there, people will be busy selling hard, and as they sell hard, they'll be wiped because they're actually following a wrong market structure there. So here they came back to the fair value gap that was left behind. I believe they tapped it. They tapped this extreme fair value gap. Yeah, they actually tapped the extreme fair value gap there. So there on the extreme, you can even go lower, 15-minute, 30-minute. Sometimes you can even go to 5-minute, just for you to, once you see that shift, you jump into that trade. Then you would have put your stop loss below this level, just like that. Then here on the 4 hour, they finally confirmed like this, you realize that the confirmations, they always start there on the lower time frame before they even come to the 4 hour. So it's not even wise sometimes to wait for the 4 hour confirmation before you jump into that trade, especially when you're aware of the overall market structure, where we're coming from and where we're headed. So eventually they went up, and as they went up, you could have also maximized on the same idea. This is the first short-term TP, but the best TP that you need to learn is this one, where you follow market structure up until where it shifts. So this was the new high, new low, meaning you can now shift. If ever your stop loss was here or wherever down here, you can now put it just below here. Then as they create a new high, they came back here, they didn't take you out, they're still going. That's a new high. That was our new high, our new low, new high, new low. So whenever they create this new internal higher lows, you basically be shifting your stop loss higher to those levels. New high, new low. So it means ultimately you would have managed to hold this trade all the way to this level, even if they came now. So if ever you logged all your profits below here, they were going to take you out there with all that profit that you would have held from here. It's different from someone who is just targeting this. Yes, in as much as targeting this is correct, it's not wrong, but there is a better way of maximizing on that same move that someone can literally not maximize out of a lack of knowledge and whatever. So eventually they came and changed character. If you notice, this is now a change of character. That is what we now call a change of character. If you understand the difference between an inducement leg and a change of character leg, that will be a big difference maker, especially in your trading, because this is an inducement. This is a change of character. These are two different things. Two different. Here, if it failed to change character here, it was basically going to keep on buying, right? And people here, if you call this a change of character, people will be busy selling here. And as you sell there, so long as an inducement, they will take that out, because according to the principles of institutional trading, that's a wrong market structure on its own. So this change of character is what made that a swing what? A swing leg. If you notice these legs that are inside there, these are not swing legs. These are basically internal legs. I think I've mentioned that. These are internal legs. That's an internal higher low. This is an internal higher low, right? So if you look at our external structure, this is our previous swing leg. Our next swing leg is that one. And this is our previous swing higher low. And it actually came all the way to the swing higher low. Then eventually they did the shift there. So meaning we now have our new higher low around those areas there, around those levels there. You realize that it will also change character to the upside, but you don't need to wait for the change of character to the upside for you to enter that trade. Immediately once they give you a confirmation like this, of which this is actually a later confirmation, this one, on a lower time frame, you realize that just here after tapping the zone, you draw your zone on a higher time frame, obviously, but when you go to a lower time frame, 15 minutes, you actually see the shift. There's a shift that would have happened before even this 4 hour shift. So immediately they actually came now and did this change. So you realize that swing legs basically, if ever we are to really explain them in institutional language, swing legs are basically change of character, legs that are being formed by your change of characters. Those are your swing legs. Then your internal legs are basically those ones that are being formed by your normal inducement like this. For example, here, this was a normal inducement. Made this a simple internal leg like this. Then they came, did a mini inside break like that. So here, let's say this market wanted to shift the overall structure from being bullish, because remember, overall structure is still bullish. Overall structure is still bullish. Let's say they now wanted to turn bearish. What could have happened here were two things. They could have done this. This inducement could have happened, yes, but what was never going to happen was the change of character. So they would have maybe tapped around this level if ever they wanted to change the overall, which is taking this overall leg here. So they would have induced here, give you sort of like a pullback into this overall structure. Then once they do this pullback, then they'll shift. Once they shift there, people who are wise enough, they'll actually take sales from there. Then they'll come and take this whole leg out, of which that will be a major change of character. It's different from this one. This one is a minor change of character because it's still within our overall order flow. But that one will be a major one whereby the overall structure now is overally now bearish. That was how they would have done it. So it actually happens so many times. It actually happens so many times of which, so here you literally see that they eventually came and took this out. They eventually came and took this out. Took this, let me see. Did they take this out? Okay, let me extend this like this. Okay, so here two things literally happened now. So what they did is also good because even if you took sales from up there, you're still going to make money. Like, what do I mean? I mean, here, obviously, you would have bought. These trend lines are not the reasons why the market went up. There are people who draw trend lines and tell you this market went up because of trend line. No, the market is going up. That's why the trend line was broken. So here, that was a simple one. Let's see where the shift happened up there. They did a shift before here. So this is one scenario that they also use. If ever they want to change to the downside, they can do this here. But eventually they failed. But even if you took sales from there, that was a very successful trade, a very successful professional trade that you could have taken from there. Your TP here could have just been, you could have targeted this whole leg like down there. So it was very, very, very successful. But eventually now, so when you see them now doing the shift again here, it means they failed overall on that agenda to shift the overall direction. They are still maintaining the overall direction that they were initially going per se. So eventually they changed character to the upside. But before they did that, they did the shift to the upside as well, which was it's actually even lower than this. It's actually inside here. If you notice where the shift happened, it's literally somewhere around here. Something like this. So if you go to a lower time frame, it's a very, very clear shift right there. Once you see it, once you look at it and you see it there, I don't need to draw these trend lines. The purpose why I'm drawing these trend lines is for some of you that are still thinking trend lines, there's nothing magical about these things. These things are basically things that you don't even necessarily need. If you understand market structure as raw as it is, you don't need these things. So there, that was where you could have bought. Buying there, your major target is obviously the swing leg, obviously, right? The swing leg, even structure, if it keeps on being bullish, you can even still hold on to those buys. So yeah, once you get your entry, your major target where you are targeting is up there. And if you want to scale in, you can scale in using internal structure. As it will be going like that. So here you notice this was a simple inducement. That was a simple break. Like that. So these guys that are confusing inducement with change of character, in this simple scenario here, they could have sold right here when the market came back to this level. You would find them selling, putting their stop loss above here. Then they are wiped like that. So it's a very important thing that you must learn, the difference between inducement and change of character. It's a very important difference for you to learn and master. So yeah, they came again, induced, then they broke structure. They broke structure where right here, and even this pullback could have given you some entries. You could have entered some entries right here, especially here. They came back to the extreme. Then you could have bought there because our major target hasn't been reached. So there is no shift of this internal order flow that is going to happen. So they maintain it up until the major TP is hit up there. So eventually major TP was hit. So you get to understand, once you master the art of maximizing on these major moves, you don't necessarily need to trade every day. You don't necessarily need to trade every day, because if you're catching these successful moves so easy like this, if you notice it kept on buying, and if you applied also the idea whereby you can follow structure up until where it shifts, if you applied also that idea, you would have also been following this structure. That was a new high, new low, new high, new low, new high, new low, new high. So you could have just been locking your profits here on these internal high lows, high lows, high lows. You would have just been locking your profits there. Then as you lock your profits, you just wait upon the market, because I think it was actually creating those are now new highs that are now being created up there, right? Those are now new highs. That's how you literally follow through on those particular trades. So it kept on going and 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 going. So literally you were just supposed to be following your structure and your order flow. There was nothing crazy to be doing here. Just following your structure and your order flow. Someone can draw all sorts of channels. Those things are not, they're not necessary because these institutions, they are aware of what you want to see. They know that you want to see this. Once you see this, they know what you're going to do. They know most of you think this market is now coming down like this. That's what they actually want you to think. They actually want you to think like that. So they create these channels that you guys hear people saying, hey, channels, channels, channels. Do you know these channels are even created by institutions intentionally? These channels are created intentionally for you to see, for you to even uh take action on them. These channels, they are so whenever people see a channel like this, what are they gonna do? They're going to draw maybe a resistance here, maybe they'll put a resistance maybe around here. Then they'll tell you, so we have broken out of the channel. Once we come back, you sell hard, stop loss above, blah, blah, etc., etc. Here you would have sold, the market would have dealt with you thoroughly. They were wiped. So I'm not even in agreement with most of these retail ideas that you have been told. I literally am not even in agreement with them, and I can even prove why I'm not in agreement with them. They can break out of your channel and keep going where they were going. So you can't be using these things to make your trading decision to say, I'm entering because a channel was broken. A channel was broken. The next question that some of us are going to ask you is, okay, a channel was broken. Was structure broken? You realize that that person might not even be able to answer that question. So yeah, if ever you were following structure very well, it was very, very easy to even keep on uh moving with the whole entire move. So yeah, that was an inducement. That was a break. This was all internal structure now being followed like that. Then they came again, they induced here. That's not a change of character there. So the minute you mistake that and call it a change of character, by the time the market comes back here, you are the same guys that are busy selling, which is exactly what they want you to do. They want you to be selling there. That's why it's called an inducement. An inducement is basically to make people think that the structure has shifted, yet the structure hasn't shifted. The change of character leg is this one. In this case, the inducement leg is that one. So that difference, in as much as it seems like so easy to see whenever you're just looking, say, because it's because I know where the legs are, but for someone who is not used to that, it may not be that easy. So yeah, where did they shift? The shift literally happened around here. After this shift, you could have bought immediately. Even when they came back there, you would have even added more buys. Your stop loss would have just been here. This is your first short-term TP. The next TP is when the market, where the market is going to induce. That's your next TP. So eventually they came and induced. Did they induce here? Let me see. They literally induced right here. So when they induced there, they broke again. So yeah, this was basically the structure that you're now following. You're following internal structure. It's sort of like even the current market structure that is happening now on US 30, like now, right now, where the market is right now. I'll show you. We are basically following internal structure. That's what we've been trading ever since January. It's basically the internal structure that is basically still running, still pushing like that. So yeah, this was a simple buy. Came back to the extreme leg or extreme level of the internal structure. That was a simple buy. If you go to 15-minute or 5-minute, you can actually see the shift nicely. You can actually see the shift nicely. They actually came again and induced. So if you listened to the other idea that we spoke about yesterday, which is the idea of understanding, what you call this, of understanding the market when it's gaining momentum and when it's losing momentum. Once you understand a gain in momentum, you literally see that even when the market is about to lose momentum to that particular direction. So again, in momentum, we spoke about it in terms of you seeing these expanded moves when the market begins to expand moves, giving you these longer moves. For example, this one, you see that they're actually gaining momentum. The legs are increasing in length as well. That's a gain in momentum. So when they are now losing momentum, they do the complete opposite, whereby they start to bit by bit, you see the legs getting shorter and shorter and shorter and shorter and shorter and shorter. Like here, from down there, you can literally see there was a shift there, a shift up until eventually they did the overall change of character. That's how you know even that's how you can even predict that most probably now a change of character is coming. So here, let me just put this nicely. Here you could have even entered the sniper buy here. That was a sniper entry that you could have entered there. Then they came, they broke structure. They broke again here. Go back. So eventually, you will literally see that they eventually came and managed to change character. The change of character date simply means we now have a new swing leg, which is what you're going to mostly see on US 30. On the current market structure where US 30 is now, what we just want to see is this something like this, whereby they will change character like this. Once they change character, we know that we now have a new swing leg. Once we now have a new swing leg, the market will follow. It can flow in that bearish order flow up until they create a new swing leg, basically. So here we now have a new swing leg. My new swing leg is that one. Where is my previous swing legs? We have that one and that one. So even if this market comes, if it does this, if they flow in bearish order flow up until maybe, even if they break, right? Even if they break this swing leg, it means you would have made money with sales coming down. So if they don't break as well, you would have still made money with the buys, with the sells, then you literally still make money with the buys. So your only job there was now to follow that bearish order flow to the downside. Once you understand your correct legs there to the downside, you were basically supposed to catch that overall. That was an adjustment there. Okay, and they broke there. Okay, we did a break, meaning we now have another swing leg as well. They did break there, and the new swing leg was now this current one there, which is literally here, like this. So throughout this entire time, you were basically trading internal structure. So even here, if you notice this internal structure, that was a new high, that was a new low. Even here, I would have even taken a buy, or even after this internal break, someone could have even taken a buy. Those are very simple trades to just look out for. So there you could have targeted this adjustment leg as your TP, or you could have just followed structure up until where it shifts. So if you followed structure up until where it shifts, you literally see that there was no shift that happened inside here up until they broke that structure. Because from this leg, that was a leg, that was a leg, that was a leg, that was a leg. By the time they create these new internal legs, this entry that you entered here, you can literally shift stop loss to break even because we now have this new leg which is guiding and protecting your entry there. So that was a new leg there. When they came back here, you would have even added more buys. Then when they break it, you can shift stop loss to entry, new leg. This is not a new leg. Okay, let me do this. The new leg after there was basically that one, that one, that one, that one, that one, up until eventually they broke the overall structure like that. So this is basically how you catch these simple moves. Someone can come and draw. There's also a way if ever you want to add this channel confluence to your analysis. There is a way of doing it. I always tell some of the guys that are in the class there that, do you know that when you align your retail ideas with, if you align your retail ideas with the institutional price action, let's say you understand where institutionally we are coming from and where we are going, then you align your retail price action with that institutional understanding in your head. You literally see that even maximizing on these moves, it will be so easy for you to maximize on them, because you're not violating the institutional principles. You're basically aligning your retail analysis. You're adding retail confluence basically to an institutional price action that you already now know. It's different for someone who doesn't understand institutional price action, because that person, they can easily be manipulated by very, very simple things, very, very simple things, very, very, very simple things. So for today, I think we are going to stop here. When was this? I think we'll stop here. Let me go back to the daily. Right. So basically, this is how you're basically supposed to be trading throughout this entire time. And the most funny part about this, you literally see that for a whole 1 full year, the market was pushing in one direction, in one order flow, in one direction. There were no sales there that were even worth taking. You can't be taking sales in a market in a market that is still strongly to the upside like that. You're basically supposed to be taking buys and buys up until there is a shift, up until there is a shift of overall order flow or overall structure to the downside. That's when you can make a decision to say, now I'm now changing my bias and everything. But so far, there was nothing there. The market kept on being bullish. Even here after this inducement, they just did a pullback, broke structure there. Your new swing leg was now this one. So if they come and check this out, that was now an overall change of direction now. That's where you now start to focus more on sales and whatever.